Welcome back to the deep dive. You know, we love to explore unique approaches to business and investing.
And today we're diving into one that's really caught our eye.
Yeah, it's called Dhandho.
And it's a philosophy that kind of turns traditional investing on its head.
For sure. And to really grasp Dhandho, we got to understand the story behind it.
Yeah, the story of the Patel community in the U.S.
Right. These folks came from practically nothing and built an empire in the motel industry.
They went from almost no presence 35 years ago
To now owning over half the motels in America.
over $40 billion in assets.
It's incredible. And their journey is the perfect illustration of Dhandho in action.
Which is exactly what we'll unpack today.
The book, The Dhandho Investor by Mohnish Pabrai, uses their success to lay out this whole low-risk, high-return philosophy.
So Dhandho, it's a Gujarati word meaning endeavors that create wealth.
And the basic idea is to shift that typical risk-reward balance.
Instead of high risk, high reward.
Dhandho is more like, heads I win, tails I don't lose much.
Exactly. It's about minimizing your downside while maximizing your potential upside.
So it's a lot less about gambling and a lot more about making smart, calculated decisions.
Precisely. And we're
Neat.
going to see how this plays out, not just with motels, but with other examples too.
Like Richard Branson and the Virgin Group.
Yeah, and steel magnate Lakshmi Mittal.
And even Mohnish Pabrai's own investment journey.
All right, so let's rewind the clock back to the 1970s.
The Patels refugees from Uganda arrive in the U.S.
With limited capital and resources.
right in the middle of a recession.
But here's the Dhandho twist. This downturn actually worked in their favor.
Because...
Well, motel prices were super low and financing was available.
So they saw opportunity where everyone else just saw obstacles?
Exactly, and they were willing to put in the work.
One of the early Patel motel owners said, "It only required a small investment and it solved my accommodation problem because I could live and work there."
They were living and working on site.
Cutting expenses and maximizing returns from day one.
Talk about resourceful.
Okay, so one story that really struck me was Papa Patel.
Oh yeah, he's a Dhandho legend.
This guy bought a 20-room motel for just $5,000.
$5,000.
And he turned that into $20,000 in annual returns.
A 400% return on investment? That's insane.
So how did he do it? Break it down for us.
Right, so first he got financing for most of the purchase.
So he minimized his upfront costs and risk.
Right, if things went bad, he didn't personally lose that much.
Plus, the bank really didn't want to run a motel.
So they were more likely to work with him.
Makes sense.
Yeah.
So limited downside, massive potential upside. Classic Dhandho.
It is. But he didn't stop there. He also kept operational costs super low by doing a lot of the work himself.
Smart. He was hands-on.
And he focused on occupancy over room rates.
Keeping that cash flow coming out.
Exactly. And he built a strong community around his motel.
Attracting other Patel families to work and stay there.
It was a genius move.
So it wasn't just luck. It was a combination of spotting the opportunity, minimizing risk, and then applying those smart hands-on strategies.
That's the Dhandho way. Now think about businesses you're familiar with.
Do you see any parallels?
Businesses where a low initial investment and smart operational tactics could yield similar outsized returns.
I bet our listeners are already making those connections.
But we're just getting started. Next up, we're moving beyond motels to see how this Dhandho philosophy works in a totally different arena.
Richard Branson's Virgin Group.
Yeah, stay tuned for that. Richard Branson.
Right. The guy's a legend.
But his success with Virgin, it's not just about personality.
Yeah, there's definitely a method to the madness.
Absolutely.
Yeah.
It's all about Dhandho. Their capital allocation strategy is brilliant.
So how does a company like Virgin with over 200 businesses use Dhandho?
Well, look at Virgin Atlantic.
The airline.
He entered a notoriously capital-intensive industry with very little investment of his own.
How is that even possible?
Dhandho magic. He leased a Boeing 747.
So he spread the cost and the risk.
Right. And he partnered with other companies to handle stuff like maintenance and ticketing.
So Virgin Atlantic could get their brand out there quickly.
With minimal downside.
And by the time the competition caught up,
Virgin was already soaring.
classic heads I win, tails I don't lose much.
Exactly. And they did this over and over again with different ventures.
Like what?
Remember Virgin Pulse?
Their electronics line.
Yeah.
Eh.
Instead of building their own stores.
They partnered with Target.
Exactly. They leveraged Target's existing infrastructure and got prime shelf space
Minimizing their risk.
while reaching a ton of customers.
That's smart. And what about Virgin Mobile?
Oh, that's a perfect example. They partnered with Sprint.
Sprint provided the entire network.
Yep, Virgin focused on branding and marketing to teenagers.
So Sprint took on the heavy lifting and the risk.
While Virgin focused on what they do best, building a cool brand.
Didn't Virgin Mobile become the fastest business to hit $1 billion in revenue?
It did. In under 3 years. Pure Dhandho brilliance.
It's incredible how they find those creative ways to limit their downside.
While maximizing their gains.
Okay, so we've seen Dhandho in action with motels and Virgin, but what about larger, more traditional industries?
Oh, Dhandho can work anywhere. Take Lakshmi Mittal, the steel magnate.
He went from one steel mill to a net worth of over $20 billion.
His journey is a Dhandho masterclass.
Tell me more.
Mittal's strategy was all about buying struggling steel plants.
At bargain prices.
Exactly. These were assets that other people saw as liabilities.
Because they were burdened with debt and all sorts of problems.
But Mittal saw their potential.
So it was a risky move.
It was. But he had a keen eye for value, and he knew how to run these businesses efficiently.
He wasn't just gambling, he had the expertise.
Exactly. Like with the Karmat Steelworks in Kazakhstan.
What happened there?
He bought it for almost nothing
No way.
and turned it into a profitable operation.
Wow. So he was buying low and then using his knowledge to turn things around.
That's the Dhandho magic. He did the same thing with other struggling plants. The Sidex steel plant in Romania, the Cebolsa mill in Mexico.
Wait, the Mexican government sold him a plant for $220 million that cost them over $2 billion to build.
Yeah, he was a master negotiator.
So it wasn't just about buying low, it was about knowing how to unlock the hidden value.
And that's where his deep understanding of the steel industry really shined.
Dhandho plus expertise.
A powerful combination.
Oh.
Now this brings us to Mohnish Pabrai, the author of The Dhandho Investor.
He actually applied these principles to his own business before he wrote the book.
He did. He started a software services company called Transtech.
And he used Dhandho
From the very beginning, he left a stable job.
to start his own company.
Yep, and he funded it with minimal capital.
That's risky.
It is.
Yeah.
But he saw an arbitrage opportunity.
What do you mean?
Well, at the time, talented software engineers in India were way underpaid compared to their American counterparts.
I see.
So Pabrai connected these skilled engineers with the booming demand for software in the U.S.
He bridged the gap.
And he structured his business to minimize risk.
So if it failed,
His losses would be limited.
but if it succeeded,
The sky was the limit.
and it did succeed,
He grew Transtech into a multi-million-dollar business.
and eventually sold it for a nice profit.
But he didn't stop there. He took his Dhandho framework and applied it to investing in the stock market.
So he's a real-life Dhandho investor.
He is. And his approach is fascinating. We'll dive into that next.
Okay, so Mohnish Pabrai is a real-life Dhandho investor.
He is. And his approach is all about finding those undervalued businesses with strong fundamentals.
Yeah.
Just like those steel mills we talked about.
Right. He focuses on what he understands.
And always looking for that limited downside with big potential upside.
But knowing when to sell is just as important as knowing when to buy.
Absolutely. You got to have an exit strategy.
Otherwise, you're just wandering around hoping for the best.
Exactly. And to illustrate this, we're going to look at a story from the Mahabharata.
The Indian epic.
Yeah, the story of Abhimanyu.
Okay, I'm listening.
So Abhimanyu was this great warrior. He knew how to enter this complex battle formation called a chakravyu.
Sounds intense.
It was. But the problem was, he didn't know how to get out.
Oh, no.
He charged into battle without thinking about his exit strategy. Well, it didn't end well for him.
That's a tough lesson.
But it's a crucial one for investors, too.
Mm-hmm.
Before buying a stock, think of it like entering that chakravyu.
You need a clear exit plan.
You got to know when and why you'll sell.
So don't be an Abhimanyu.
Right. Have an exit strategy. Now, here are a couple of rules to keep in mind. First, avoid selling at a loss within 2 to 3 years of buying.
So give the business time to perform.
Exactly. Let your investment thesis play out. Don't panic at the first sign of trouble.
Patience is key.
It is. Second, always reassess the value of the business.
And if the market price goes above what you think it's worth,
Be open to selling, even if it means a small loss.
because sometimes it's better to move on to better opportunity.
Right. It's about maximizing your overall returns,
Yeah.
not holding on out of stubbornness.
Okay, so we've covered finding those Dhandho opportunities and having an exit strategy.
Yeah.
But there's another crucial element we haven't touched on yet. Focus. And for this, we're going back to the Mahabharata.
Another warrior, another lesson. This time it's Arjuna.
Okay, tell me about Arjuna.
Well, he was famous for his archery skills. His teacher challenged him to hit the eye of a fish.
The eye of a fish.
Yeah, but the fish was reflected in the water.
So a moving target.
A moving target. reflected in the water. Talk about focus.
That's incredible. So what's the lesson here?
Well, amidst all the distractions, Arjuna could only see the eye of that fish. That's the kind of focus we need as investors.
So we need to block out the noise.
Exactly. Tune out those distractions. Define your circle of competence.
What does that mean?
It means focus on the industries and businesses you truly understand.
So become an expert in a few areas rather than trying to know everything about everything.
Precisely. Don't try to chase every hot stock tip. Be like Arjuna. See only the target.
I like that. So focus on what you know and do your research.
Absolutely. Now, speaking of focus, let's circle back to risk and uncertainty for a second.
Okay.
Remember the barbershop example?
The one where the barber opens a shop in a new town.
Yeah, he faces a lot of uncertainty. Will people come to his shop? But his risk is low because he hasn't invested much.
That's the heart of Dhandho, right?
Yeah.
Looking for situations with low risk but high uncertainty.
Because those are often the situations where you find those hidden gems.
Yeah.
The market misinterprets the uncertainty as risk.
And drives the prices down.
Exactly. And that's where the Dhandho Investor comes in.
Okay, so can you give us a real-world example of this?
Sure. Let's look at Stewart Enterprises.
What do they do?
They're a funeral services company.
Okay, that's a business that's not going anywhere.
Right. It's simple, stable, predictable.
Yeah.
But back in 2000, their stock price crashed.
Why?
Well, they had some debt, and some industry events shook things up.
So the market panicked.
Basically, the stock went from $28 a share to under $2 a share.
Wow, that's a big drop.
It is, but Mohnish Pabrai saw an opportunity.
What did he see?
He saw that the market was overreacting. Yes, the company had some debt, but the underlying business was strong.
They had a moat.
They did customer loyalty, limited competition, and a growing customer base.
So he saw a low-risk, high-uncertainty situation.
And he bought a bunch of stock at under $2 a share.
With a plan to sell it anything over $4 within 2 years?
He had his exit strategy in place.
Yeah.
It worked. Within a few months, the company announced plans to sell off some assets to reduce debt.
So the market calmed down.
And the stock went up. Pabrai sold his shares and made a nice profit.
Another Dhandho win.
It just goes to show that Dhandho is not about hitting home runs every time.
It's about making smart, calculated decisions.
And minimizing your losses.
So you can win in the long run.
Exactly. It's a marathon, not a sprint.
Yeah.
And speaking of long-term thinking,
Didn't Warren Buffett say the stock market is a device for transferring money from the impatient to the patient?
he did. And that's the essence of Dhandho. Be patient, wait for the right opportunities.
And then hold on to those investments.
Don't get swayed by the ups and downs of the market.
Because in the long run, a good business will perform.
That's the Dhandho philosophy.
So we've covered a lot of ground today, from motels to airlines to steel to the stock market.
It's clear that Dhandho is more than just an investment strategy.
It's a way of thinking about business and life.
It's about understanding risk-spotting opportunity, making calculated decisions, and being patient.
It's about being resourceful, disciplined, and focused.
It's about being a Dhandho thinker.
And that's something we can all learn from.
Absolutely. So as we wrap up this deep dive into Dhandho, remember, it's all about tilting the odds in your favor.
Minimizing your downside and maximizing your potential.
It's about making smart bets and sticking with them.
It's about taking control of your financial future.
That's the power of Dhandho.
Well said. Thanks for joining us on this deep dive into Dhandho. Until next time, fellow learners, keep learning, keep exploring, and keep those Dhandho principles in mind.